For the past several months, something quiet has been happening inside the global banking system. It has not made front-page headlines. It has not triggered emergency press conferences. There have been no dramatic market crashes attached to it, at least not yet. But deep within regulatory filings, central bank consultations, and balance sheet disclosures, the rules around risk are being adjusted. And when rules around risk change, the structure of the financial system changes with them. Let's begin with a simple but uncomfortable question. What if the next banking crisis does not begin with bad loans, collapsing housing markets, or reckless speculation? What if it begins with risk being quietly moved, prepackaged, transferred, and redistributed across institutions, still no one is entirely sure who actually holds it? Modern banking is not just about deposits and loans. It is about capital ratios, derivatives, exposure, securitizations, and complex instruments designed to manage uncertainty. On paper, these tools make the system safer. They allow banks to hedge losses, free up capital, and continue lending even during stress. But history shows that when risk becomes too abstract, it becomes harder to measure. In 2008, the crisis did not begin with obvious defaults. It began with mortgage-backed securities that were considered stable. Risk had been sliced, rated, and distributed. For a time, the system looked strong. Banks reported healthy capital levels. Markets were calm. Then confidence broke. More recently, in 2023, regional banking stress in the United States did not start with widespread loan defaults either. It began with duration, risk interest rate exposure embedded in bond portfolios. The assets were technically high quality. But when rates rose quickly, the unrealized losses became real in the eyes of depositors and investors. In both cases, the trigger was not obvious recklessness. It was structure. That is why technical regulatory changes matter. They signal that policymakers see pressure forming somewhere in the system. Regulators do not rewrite capital treatment rules without reason. When they adjust how banks can transfer risk, it usually reflects a deeper concern about leverage, liquidity, or interconnected exposure. Today, central banks and global regulators are refining the framework around what is called risk transfer. At a surface level, this sounds prudent. Banks are being encouraged or required to be more precise about how they move credit risk off their balance sheets. The language is technical. The discussion is framed around resilience and transparency. But behind that language lies a larger structural shift. Risk transfer allows banks to package portions of their loan exposure and pass that risk to other investors, often through synthetic structures or securitized instruments. In theory, this spreads risk across the system and prevents concentration inside individual institutions. It creates flexibility. It improves capital efficiency. Yet, there is an important principle in financial systems. Risk does not disappear. It relocates. When regulators refine the rules around relocation, they are acknowledging that the current distribution may not be stable. The invisible architecture of the system is being adjusted. For most people, this feels distant. Deposits are insured. ATMs function. Markets open and close each day. Nothing appears broken. But systemic stress rarely announces itself loudly at first. It builds quietly in technical layers through accounting treatments, capital buffers, and off-balance sheet structures that only specialists follow closely. The question is not whether regulators are trying to strengthen the system. They are. The deeper question is whether strengthening one part of the system may be shifting fragility into another. Because when risk moves, incentives change. And when incentives change, behavior follows. If banks can transfer more risk efficiently, they may lend more aggressively. If investors absorb that risk in search of yield, exposure accumulates in new corners of the market. Over time, the visible stability of bank balance sheets may mask growing complexity elsewhere. This is not a prediction of collapse. It is an observation about structure. Something technical has changed. And when the plumbing of finance changes, the flow of money changes with it. So the real issue is not whether risk transfer exists. It always has. The real issue is this: what exactly changed in the rules and why now? To answer that, we need to look closely at how the system normally works. and what signals regulators may be sending beneath the surface. To understand what changed, we first need to understand how banks normally manage risk. At its core, banking is a simple model. A bank takes deposits and makes loans. Those loans generate income, but every loan carries uncertainty. Borrowers can default, asset prices can fall, interest rates can move sharply. So banks are required to hold capital as a cushion against losses. Capital is not the same as deposits. It is the bank's own financial buffer, shareholder equity, and retained earnings. Regulators require banks to maintain specific capital ratios, measured against their risk-weighted assets. The riskier the assets, the more capital the bank must hold. In addition to capital, banks maintain reserves and liquidity buffers. They conduct stress tests. They adjust lending standards. In theory, these layers create resilience. If losses occur, the bank absorbs them without collapsing. But here is the tension. Capital is expensive. The more capital a bank must hold, the less it can lend relative to its balance sheet. And lending is how banks earn money. So over time, financial engineering evolved to solve a problem: how to reduce the capital burden without reducing lending. This is where risk transfer enters the picture. Risk transfer, in simple terms, means shifting the economic risk of a loan from one party to another. The loan may stay on the bank's books, but the credit risk is partially or fully passed to investors. One traditional method is securitization. A bank bundles loans, mortgages, auto loans, corporate debt and sells them into structured products. Investors buy these securities and receive the cash flows. The bank removes some exposure and frees up capital. A newer method is synthetic risk transfer. Instead of selling the loans outright, the bank uses derivatives, such as credit default swaps, to hedge the risk of default. The loans remain on the balance sheet, but if losses occur, a third party absorbs them in exchange for a premium. On paper, this improves efficiency. The bank appears safer because it has reduced net exposure. Its capital ratios improve. It can continue lending without raising additional equity. But the system as a whole may not be safer. The risk has simply moved to another institution, often insurers, pension funds, asset managers, or specialized credit vehicles. And this is where the new regulatory adjustments matter. Global regulators, influenced by Basel frameworks, are refining how these transfers are treated for capital purposes. They are tightening disclosure requirements. They are clarifying when a bank can count transferred risk as genuine protection. They are scrutinizing the quality of counterparties absorbing that risk. Officially, the goal is resilience. Regulators want to ensure that when banks claim risk has been transferred, it truly has been. They want to avoid a repeat of past crises where protections failed under stress. But whenever rules change, incentives shift. Banks respond rationally. If capital treatment becomes stricter in one area, financial innovation seeks flexibility in another. This is not malicious. It is structural. The system adapts. Over time, this creates a feedback loop. Regulators tighten standards to reduce fragility. Banks optimize around those standards to maintain profitability. Optimization introduces new complexity. Complexity introduces new blind spots. Regulators respond again. This cycle has repeated for decades. After 2008, capital requirements increased sharply. Stress testing became more rigorous. Leverage ratios were tightened. For a time, balance sheets looked stronger. But low interest rates compressed margins. Investors searched for yield. Structured credit markets slowly rebuilt. Private credit expanded. Risk did not vanish. It migrated. When regulators now focus specifically on synthetic risk transfers and capital relief trades, it signals something important. It suggests that the volume of these transactions has grown large enough to attract concern. Why would banks lean heavily on risk transfer today? One reason is the rate environment. Rapid interest rate increases over the past few years have changed asset valuations. Banks are managing unrealized losses in bond portfolios while also facing higher funding costs. Capital flexibility becomes more valuable in this environment. Another reason is credit uncertainty. As growth slows and debt burdens rise, the probability of defaults increases. hedging that risk becomes attractive. Transferring portions of exposure can protect reported capital ratios, but here is the deeper signal. When institutions work harder to manage capital optics, it often reflects rising stress beneath the surface. Historically, major rule adjustments rarely occur in calm low-leverage environments. They emerge when activity accelerates, when certain structures grow quickly, when exposures concentrate, or when regulators sense that interconnectedness is deepening. The rules themselves are not the problem. In many cases, they are sensible. The signal lies in their timing and focus. When oversight concentrates on how risk is being moved, it suggests that leverage is not simply sitting on traditional bank balance sheets. It may be embedded in layered transactions that depend on counterparties performing exactly as modeled. And in finance, models work best in stable conditions. The question is, what happens when volatility rises? If multiple institutions rely on similar hedging structures, and if those structures depend on liquidity in stressed markets, then risk transfer can become risk amplification. A hedge that functions in normal times may fail when everyone tries to exit at once. This does not mean crisis is inevitable. It means the system is becoming more interconnected through contracts rather than through direct loans. So the big signal is not just that rules changed. It is that regulators are watching the plumbing of credit markets more closely. And when supervisors focus on plumbing, it is usually because pressure is building somewhere upstream. The next step is to look beyond banks themselves, because if risk is being transferred, we need to understand who is absorbing it and what that means for the broader structure of power in the global financial system. If regulators are focusing on the plumbing, then we have to widen the lens, because the real issue is not whether banks can move risk. The real issue is where that risk goes in, who ultimately carries it. When stress arrives, when a bank transfers credit exposure, it does not send that risk into empty space. It moves into the portfolios of other financial actors. These may include insurance companies seeking long-duration returns, pension funds trying to meet future obligations, asset managers building structured credit funds, or private credit vehicles operating outside traditional banking rules. This area is often called the non-bank financial sector, or, more informally, shadow banking. These institutions are not inherently reckless. In many cases, they are conservative by mandate. Pension funds, for example, need predictable cash flows. Insurers must match long-term liabilities. But when yield is scarce, structured credit products become attractive. They offer incremental return in exchange for complexity. And complexity can obscure concentration. Banks operate under tight regulatory supervision. They undergo stress tests. They report capital ratios quarterly. Non-bank entities face a different framework. Disclosure may be less frequent. Leverage may be embedded indirectly through derivatives. Liquidity assumptions may rely on market functioning rather than deposit stability. So as risk migrates outward, transparency can decrease. Now consider the incentives. Banks want flexibility. They want to maintain lending capacity without raising new equity. Regulators want stability. They want to prevent taxpayer-funded rescues. Investors want yield. They are under pressure to generate returns in a world of volatile rates and rising obligations. These incentives do not always align. When economic conditions are stable, this balance can function smoothly. Risk is distributed. Capital flows efficiently. Credit expands. But today's environment is not stable. Global supply chains have been under stress for years. Trade tensions have increased. Strategic industries, from semiconductors to rare earth minerals, are being reshored or reorganized along geopolitical lines. Energy markets have experienced shocks. Commodity prices have swung sharply in response to conflict and policy shifts. These forces increase uncertainty in the real economy. When supply chains fragment, costs rise. When energy prices spike, margins compress. When trade routes shift, capital expenditure increases. Companies borrow to adapt. Sovereigns borrow to subsidize or stabilize. Debt levels climb. This matters because financial risk ultimately rests on economic performance. Loans are repaid from real cash flows generated by real businesses operating within real supply chains. If those supply chains become less efficient, less predictable, and more politicized. Underlying credit risk rises. At the same time, sovereign debt burdens are expanding. Governments financed pandemic responses, energy subsidies, and industrial policy initiatives through borrowing. Higher interest rates have increased servicing costs. Fiscal space is narrower. So we have a layered structure. Banks are refining capital efficiency. Non-bank investors are absorbing structured risk. Corporations are navigating fragmented trade networks. Governments are carrying elevated debt loads. Each layer depends on the others functioning smoothly. If commodity volatility increases, corporate earnings become less predictable. If earnings weaken, credit quality deteriorates. If credit risk rises, the value of transferred exposures declines. If those exposures sit in leveraged funds or derivative structures, losses can amplify. And here is the key principle again. Risk does not disappear. It changes hands. In a tightly regulated bank, risk is visible. It sits on balance sheets, reviewed by supervisors. In a pension fund portfolio structured through multiple vehicles, risk may be harder to trace. It may depend on counterparties honoring complex contracts. It may rely on market liquidity during stress. When risk moves into less transparent corners, measurement becomes difficult. And what cannot be measured accurately can be mispriced. The deeper battle, then, is about control and visibility. Who truly holds the leverage in the system? Is it the regulated banks that appear stronger under new rules? Or is it the network of investors and funds that absorb the transferred exposure? If banks look resilient on paper but depend on external counterparties for protection, their stability is linked to the health of those counterparties. And those counterparties are linked to global capital markets, commodity flows, and sovereign balance sheets. The financial system is no longer a simple chain. It is a web. In a web, stress does not travel in straight lines. It transmits through connections. This is why geopolitical fragmentation matters. When capital flows are restricted, when sanctions alter trade patterns, when currencies are weaponized, the web tightens. Liquidity pools separate. Cross-border exposures become politically sensitive. Under those conditions, even well-designed, risk transfers can behave unpredictably, so the tension builds quietly. Banks appear stronger. Capital ratios improve. Regulators report progress. Yet underlying economic volatility persists. Debt levels remain high. Supply chains continue to shift. If fragility is no longer concentrated inside banks, but dispersed across interconnected institutions, then the next question becomes unavoidable. When pressure finally exceeds the system's capacity, where does the break occur? To answer that, we must connect this shifting web of risk to money itself, because when financial stress emerges, it rarely stays contained within credit markets. It begins to influence currencies, liquidity, and the value of savings worldwide. When pressure finally exceeds the system's capacity, it rarely stays confined to credit contracts and balance sheets. It begins to influence money itself. Because at its core, banking is not just about loans. It is about money creation. When banks extend credit, they create deposits. Those deposits circulate through the economy. They fund consumption, investment, asset purchases, and government spending. The scale of lending directly shapes the supply of money in the system. So when risk transfer expands and capital efficiency improves, banks gain room to lend. Even if the improvement is modest, across a large financial system, it can support billions in additional credit. In the short term, this feels positive. Credit growth supports economic activity. Asset prices may rise. Liquidity appears abundant. But the mechanics are more delicate than they seem. Capital efficiency depends on assumptions. If a bank transfers risk through derivatives or securitized structures, its regulatory capital ratio improves because potential losses are assumed to be absorbed elsewhere. That assumption holds as long as counterparties remain stable and markets remain liquid. If volatility rises and the value of those protections fluctuates, capital metrics can shift quickly. Now consider interest rates. Over the past few years, central banks raised rates aggressively to fight inflation. Higher rates reduce bond prices. They increase borrowing costs. They also change how risk is priced across markets. Structured credit products that look stable in low-rate environments can behave differently when rates are elevated and liquidity is tighter. If banks rely on structured risk transfer to maintain their ratios, they become indirectly exposed to credit spreads and derivatives pricing. A widening in spreads can increase the cost of hedging. Counterparties may demand additional collateral. Funding markets can tighten. This is how a shock in one corner of the system feeds back into the core. Bond markets sit at the center of this dynamic. Sovereign bonds are considered the foundation of the global financial system. They serve as collateral. They anchor interest rates. They influence currency strength. When sovereign yields rise sharply, they affect bank balance sheets, pension portfolios, and derivative valuations simultaneously. In a highly interconnected system, capital flows respond quickly. If investors begin to question the stability of structured credit markets, they may reduce exposure. That can push up funding costs. Banks may respond by tightening lending standards. Credit slows. Economic growth softens. Sovereign deficits widen further as tax revenues decline. Confidence becomes the variable that ties everything together. Modern currencies are not backed by gold reserves or fixed exchange rates. They are backed by institutional trust. Trust that banks are solvent. Trust that sovereign debt is manageable. Trust that central banks can stabilize liquidity when needed. If trust weakens in bank balance sheets, suddenly capital flows shift. International investors may reduce exposure to certain bond markets. Currency volatility can increase. Countries with large external financing needs may see pressure on their exchange rates. A stronger dollar can tighten global liquidity because much of the world's debt is denominated in dollars. Dollar liquidity, in particular, plays a central role. When global funding conditions tighten, demand for dollars increases. That can strain emerging markets and multinational corporations alike. Swap lines and central bank coordination can ease pressure, but they also highlight how dependent the system is on coordinated stability. This is where real assets enter the discussion. Historically, during periods when institutional confidence is questioned, not necessarily collapsing, but strained investors often seek assets that sit outside the credit system. Gold has served this role for centuries. It is not a liability of a bank. It does not depend on a counterparty's promise. Its value fluctuates, but its existence does not rely on contractual performance. This does not mean gold signals panic. It often signals caution. Other real asset synergy infrastructure, strategic commodities, productive land can also attract capital during uncertain monetary transitions. They represent claims on physical output rather than financial engineering. The key point is psychological. If technical rule changes in banking alter how risk is perceived, they can influence how investors think about money itself. Even subtle doubts about balance sheet resilience can increase demand for liquidity and tangible stores of value. And psychology can move markets faster than balance sheet data. We have now moved from the micro-level capital ratios and risk weights to the macro-level currency, stability, and inflation expectations. What began as a regulatory adjustment can ripple outward into lending behavior, bond pricing, and global capital flows. None of this guarantees instability. Systems can adapt. Markets can absorb shocks. Regulators can refine frameworks. But when financial architecture becomes more complex, the margin for error narrows. The final piece of the puzzle is not institutional, it is personal. Because when money, credit, and confidence shift, the effects eventually reach households, retirement accounts, and everyday purchasing power. To understand the true stakes, we need to step out of the abstract world of derivatives and sovereign yields and ask a more direct question. How does this structure affect ordinary people, and how should they think about risk in a system built on trust? So how does all of this reach ordinary people? Not through dramatic headlines at first, not through empty ATMs or sudden closures. The effects usually travel quietly through tightening conditions and shifting prices. To make sense of that, we need a few simple mental models. The first is this: risk does not disappear. When banks transfer exposure, the system may look safer at the surface. Capital ratios improve. Stress tests appear manageable. But if that risk moves into pension funds, insurance portfolios, or structured credit vehicles, then households are still connected to adjust indirectly. Your retirement account may hold bond funds. Those bond funds may hold structured products. Those products may reference loans that originated inside the banking system. The chain is long, but it exists. So the question is not whether risk exists. It is where it sits and how visible it is. The second model is this: liquidity matters more than leverage in a crisis. Leverage is about how much debt is in the system. Liquidity is about how easily assets can be bought or sold without sharp price changes. Many institutions can survive high leverage if liquidity remains steady. But when buyers disappear and funding markets tighten, even sound assets can fall sharply in value. Losses that were theoretical become real because they must be realized. For households, this often shows up as volatility. Retirement portfolios swing more than expected. Credit becomes harder to access. Mortgage rates rise, even if central banks are not actively tightening. Small businesses find lines of credit reduced. These are liquidity effects. The third model may be the most important. Confidence is a true backing of modern banking. Deposits are insured within limits. Central banks can provide emergency funding, but the system functions smoothly only when institutions trust each other. Banks lend to one another in short-term markets. Funds roll over debt. Investors assume contracts will be honored. Most financial crises do not begin with retail depositors rushing to withdraw funds. They begin in wholesale funding, markets where institutions start to question counterparties. If confidence weakens at that level, behavior shifts quickly. Institutions demand more collateral. They shorten lending terms. They conserve cash. Those defensive moves, rational on their own, can tighten conditions across the economy. For individuals, the impact can feel indirect but persistent. Credit card limits may not expand as easily. Auto loans may carry higher rates. Housing markets may cool because financing costs rise. Asset prices that felt stable may correct as institutional investors rebalance portfolios. Currency purchasing power can also shift. If stress influences bond markets and capital flows, exchange rates can move. Imported goods become more expensive. Inflation may not spike dramatically, but it can remain stubborn. None of this requires panic to unfold. It is often gradual, and it is important to be precise here. Structural fragility does not equal inevitable collapse. Complex systems can function for long periods under strain. They adjust, they adapt, they redistribute pressure. The goal is not to predict disaster. It is to understand sensitivity. When systems depend heavily on trust and layered contracts, small disruptions can cascade. A hedge that fails, a counterparty that weakens, a funding market that tightens. Each event alone may be manageable. Combined, they can amplify. For viewers, the shift is intellectual. Instead of asking, "Is a crisis coming?" a more useful question is, "Where is risk concentrated, and how exposed am I indirectly?" Instead of focusing on headlines, focus on structure. Are institutions becoming more reliant on complex transfers to maintain capital efficiency? Are funding markets stable? Are sovereign debt levels sustainable under current rate conditions? These questions encourage clarity rather than fear, and they prepare us for the final step in the story. Because once we understand how risk relocates, how liquidity shapes outcomes, and how confidence underpins the system, we can examine the range of possible futures. Not one prediction, but several plausible paths. And in a world where rules are shifting quietly beneath the surface, the future will likely depend less on dramatic events and more on how these underlying tensions resolve over time. And in a world where rules are shifting quietly beneath the surface, the future will likely depend less on dramatic headlines and more on how these structural tensions resolve. There are several plausible paths forward. The first is a stabilization scenario. In this outcome, the new risk transfer rules achieve their intended purpose. Transparency improves. Regulators ensure that transferred exposures are backed by credible counterparties. Banks maintain stronger capital buffers without excessive complexity. Non-bank institutions absorb risk in a measured, well-capitalized way. Credit growth slows to a sustainable pace. Interest rates gradually normalize. Sovereign debt remains elevated but manageable. Markets experience volatility, but no systemic fracture. In this scenario, the system adapts. The adjustments we are seeing today become part of a broader maturation process. Financial architecture becomes more resilient precisely because vulnerabilities were identified early. The second path is more subtle. A slow burn scenario. Here, risk continues to migrate outward. Structured products expand. Private credit grows. Pension funds and insurers increase exposure in search of yield. On the surface, banks look stable. Capital ratios remain compliant. Economic growth continues, though uneven. But leverage accumulates in less visible areas. A credit event, perhaps, in commercial real estate, corporate debt, or a sovereign under pressure exposes weaknesses in one corner of the shadow system. Losses do not immediately threaten major banks, but they tighten liquidity. Funding costs rise. Investors reassess risk premiums. Confidence erodes gradually rather than suddenly. This type of environment can persist for years. Markets oscillate between relief and concern. Policymakers intervene selectively. The system does not collapse, but it becomes more fragile over time. The third possibility is a shock scenario. In this case, a sudden liquidity freeze reveals that transferred risk was never fully absorbed, redistributed through contracts that depend on continuous market functioning. A sharp move in credit spreads or sovereign yields triggers margin calls. Counterparties demand collateral. Funding markets seize temporarily. Banks, believing they had reduced exposure, discovered that their protections depend on institutions now under stress. Interbank lending tightens. Central banks step in to stabilize liquidity. Even then, the outcome would depend on speed and coordination. Modern policymakers have tools that did not exist decades ago. But tools work best when confidence has not already broken. The point is not to predict which path will unfold. It is to understand what to watch. Credit spreads often widen before headlines appear. Derivatives pricing can signal stress building beneath the surface. Interbank funding rates reveal whether institutions trust one another. Sovereign bond volatility reflects pressure at the foundation of the system. These are signals, not certainties. If regulators are already adjusting risk rules today, what do they see forming beneath the surface, and will those adjustments be enough to shape what comes next?